The Bank of England kept interest rates on hold at 0.5% in a unanimous vote today. However, this could be the calm before the storm. The Mark Carney-led central bank turned notably more hawkish in its rhetoric, indicating rates would rise faster than previously expected, sending the pound on a climb. While some may welcome a bit more wind in sterling sails, and savers are desperate for higher rates for mortgage borrowers, companies, and others with debts, the latest commentary from the Bank of England heralds a fresh squeeze on their finances. So why has the bank decided it may now need to raise interest rates faster? Alongside today's Monetary Policy Committee 9-0 vote to hold interest rates came the quarterly inflation report, which contains eagerly watched commentary on the economy, inflation and interest rate expectations. It said, since November, the prospect of a greater degree of excess demand over the forecast period and the expectation that inflation would remain above the target have further diminished the trade-off that the MPC is required to balance. The reason we are at this stage is actually due to good news, not bad. As the bank pointed out in the comments accompanying the rates decision, the global economy is growing at its fastest pace since 2010. UK trade levels are benefiting from robust global demand and the past appreciation of sterling, while high rates of profitability, the low cost of capital and limited spare capacity is supporting British business investment, the bank said. All this means upward pressure on prices, and therefore is nudging the inflation rate a bit too far above the bank's mandated target of 2%. All the three main engines of the global economy, US, Europe, and Asia, are performing well this year, and we are now in the best phase of global economic growth we have seen since the financial crisis," sentence added. The upgraded UK economic growth forecasts, which were also issued, will further embolden the bank to go through with rate hikes. The bank upgraded its forecast for the UK economy slightly today, citing stronger global conditions, noted Ben Brettel, senior economist at Hargreaves Lansdown. It now expects 1.8% growth this year, as against 1.6% forecast in November.